Yeah, of course. All right. Welcome, everybody. We're back. This is our second call on the silver bullet model. This is a time-based model for anybody who does not know. So we have it's a very beginner-friendly model. Um, we have a set of rules, solid rules, and a checklist. It's a mechanical system. You see these things in the chart that happen. You just check them off, and when they're all checked off, you enter. And then from there, you follow the other set of rules that are in it. Um, but this, what happened today, is a perfect example of the overall goal and the overall aspect of what you want to see in the model. So this is an absolute gem, and I know my chart's a little dark. You'll probably have to turn up brightness to see some of it, but yeah, 10 RR today, 162 handle. That's 162 not ticks, but points. That's insane. Um, but I'm gonna run through with this with you guys. I took a lot of good notes. 10 RR, hell yeah, dude. That's what I'm fucking saying. And I went risk free pretty much right away too. Um, so we're gonna take it back in bar replay. So just to give you guys a little background on the silver bullet. So like I said, it's a time-based model. Okay, so there are specific times where you have to trade in the day for this model. Algorithmically, every single day, this stuff happens at these specific times. Not before, not after, at these specific times. Okay, so you have to stay extremely strict to this. I'll share this chart with you guys actually right now so you guys can follow along if you want. I'll put it in chat. Yeah. So I trade futures, but this model works on forex, futures, stocks, whole 9 yards. I don't know about crypto. I'm a little iffy on that. I've never back tested it on crypto, but I'm sure it works pretty similarly. Um, but yeah, I put the link in chat so you guys can check it out yourself and follow along. But we're gonna start at the beginning. All right, we're gonna start at market open. So right off the bat, let's go through the rules. Okay, this is our little guide I set up. If you open the chart, you can view it for yourself. It gives you just the background information on the strategy. I dumbed it down a whole lot for you guys. But like I said, you only take an entry when you're inside of these time zones. Okay, so this time zone that we're working with right here, this is our 10 to 11 a.m. Eastern Standard Time session. So right after market open in New York session. All right, and there are certain things that we're going to be looking for. Okay, we need to look for a liquidity sweep, a market structure shift, and a fair value gap that gets created off of this market structure shift. And I know fair value gap created off this market structure shift. You'll see what I mean. But you have to look for these things in this order. Do not deviate from this plan. Do not deviate from this guide. Okay. So right off the bat at market open, all right, we'll take it nice and slow, and I'll walk you guys through, the thought process of it all. All right. So let's we'll continue. We'll let price play out until we get to this time zone, because that's when you start to. Can you share it in the inbox? What do you mean in the inbox? The rules? Oh, you mean in the chat? Yeah, I'll put it in chat for you guys. Right there. I also put it in the notes. You can just hover over these little pinpoints I put. But yeah. So going into the time zone, we got to do analysis. You got to do analysis on all time frames. All right, all time frames. That's absolutely critical. All right. It's important to start at the higher time frame. Okay, to kind of see what we're working with in regards to it all. Let me fix this. Am I allowed to screen record? Go for it, bro. Go for it. I'm recording it too. So if you guys also want me to put this, in the chat or something, or share it somehow after this all, I can do that too, so you guys can look back on it. But looking at the higher time frame, okay. So this is our 9 o'clock candle. Very, very strong reaction. Okay, this is signifying a retracement of some sort. We got a nice pair of wicks. Okay, so I'm liking the bullish sentiment on this right off the bat. So that tells me, I'm looking for bulls more than I am bears. Okay, more upside. So like this, do that. All right. So that's our overall higher time frame bias that we're working with. But continuing on. So entering this time zone, what do we see? Okay, so right off the bat, we see right after our market open, we had a liquidity sweep. And like I said in the call before, I know a lot of you probably weren't on it, but the liquidity sweep can happen up to 30 minutes before. Okay, and I say this because you only take your entry inside of the silver bullet time zone. The liquidity sweep is able to happen. That can happen before, okay, because price takes time to develop. But you look for your entry to occur in this time zone once the other things have been satisfied. You only take your entry inside of this time zone. Okay, if it shows up a little bit beforehand, don't enter. If it shows up at 9:59, don't enter. I don't care. I know it sounds stupid, but through back testing and historical statistics, this time zone, 10 to 11, highest probability. Okay? So you stay strict to those rules. That's what makes you profitable. So we have our higher time frames. Okay? Happens up to 30 minutes before, historically speaking. And that fits in that time zone. So boom, we're good on that. So we can check off, our first little confidence. Liquidity sweep, check. I'll do this. I'll go in and give a little check. So we got a liquidity sweep. Now, because we swept, what's the probability of this strat again? I want to say it's low 70s. It's 70 to 75%. I want to say, and that's just basing it on these confluences, not basing it on additional confluences that you might have, overlapping other models on top of it. Yeah, dude, it's really good. It's really good. Typically, you're looking for a 2 to 3 RR, which that doesn't sound great, but with the high probability win rate, it's very good, very good. And that doesn't include, trend days, which I'm going to get into. Oh, man, this is good stuff. But yeah, pretty often when higher time frame liquidity is close to price before market open, we kind of expect market opening volume to sweep it out somewhere in the 930 to 945 range. It can sweep a little after 945, anywhere in that 30-minute window, really. But we would like it to sweep, 930, 945, because that gives us, we start to have a lot more time to think through things. So we have our liquidity sweep. Okay, we push up, Very nice, very nice. However, we have a buy side liquidity sweep. So something about silver bullet that happens a lot, is you have something called a seek and destroy profile. Let me change color of this. You have a seek and destroy profile, and what that is something like this. So it just keeps sweeping the outside lows and highs, and that happens a lot. Just consolidation going into silver bullet, because silver bullet is an expansionary move. It's an expansionary move, and you have something called AMD, which stands for accumulation, manipulation, and distribution. Okay, so what the AMD model kind of looks like, and I know this isn't like, you'll see how this fits. You'll see how it fits. But this right here, accumulation. This is our accumulation. It's what accumulation looks like, and it can look like different things. It could look like a search and destroy or seek and destroy profile, or it could just be trading in a range, something like this. Just some sort of consolidation, accumulating orders, and then you have manipulation. Now, manipulation is where price does something wonky. What is market structure shift? I'll get into that after I'm done explaining this. All right. But manipulation is some sort of displacement on price. Typically, it's in the form of a higher time frame retracement. Okay. So on a lower time frame, it might look like, okay, price is going down. We're finally going down, finally making a move. However, price will make a reversal. And this is what you want to see in a... I was confused with the full form, actually. What do you mean the full form? Oh, market structure shift? Okay. Yeah, I'll run through. I can run through it real quick after I'm done with this. But you'll notice that price does, this is a form of, if you really think about it, consider this an entire wick on a higher time frame. You had maybe open was somewhere up here. Okay, so the candle opens up here, comes down, it looks bearish, it comes back up, and now it's a market indecision candle. Okay. Now, when that happens, you have a big wick, big wick. Now that is manipulation. Yeah, we'll do this. Kind of, they gotta look like each other. But this is something that also has the name of, you might have heard it be thrown around, but nobody ever really actually explains it. It's called the power of three. There are models that people have built off of it. Some might know the Judas swing that plays on the distribution stage after this. So after the manipulation stage, you'll have some sort of actual decision on where the market will finally decide to go. And that could be upside, or it could be price decides to actually come down after rejecting. But that is power of three, because you have the accumulation of orders, the manipulation of orders to psych people out, etc., and then you have the actual distribution of where price wants to go, also known as an expansionary move. That is the silver bullet. That is a silver bullet, and this happens in this time zone. So we're playing on this expansionary move, and you'll see what I mean when we get back into it. But yeah, going through, keep that right there. Going through, so are you just confused on the market structure shift or the fair value gap? Or both? Okay, good talk. But the market structure shift, so it looks something like, I'll go back at price. Like to learn both? Yeah, of course, man. Of course. We'll run it through real quick. Here's an example. So something like this. So we have this trend, right? Higher highs, higher lows, right? This is a trend. This is exactly what a trend looks like. Now we're bullish, okay? These higher highs and higher lows, that's an indicator of, okay, we just going up. Price wants to go up. However, a market structure shift is when price breaks that. So we're no longer making higher highs and higher lows. Now we're making lower highs and lower lows. So it's just a switch in market direction. Sort of like change of character. Yeah, I mean, you could call it change of character. Market structure shift is just another name for it, really. But do not get it confused. See, that's what I was about to say. Do not get it confused with break of structure, because those two are very similar things. Exactly. Break of structure is the current trend. Break of structure, looking at this on the lower time frame, we've broken structure. Okay, we've broken structure, and now we're in a downtrend, etc. However, let's look at the higher time frame. So technically, on a higher time frame, let me delete that. On a high time frame, we're still looking at higher lows at least. Obviously, that's consolidation, but we're still in an uptrend technically. So on a lower time frame, yes, it's a market structure shift, but on a much higher time frame, it's just a break of structure. Does that make sense? And then regarding fair value gaps, so fair value gaps are essentially a play on break of structure is in higher time frame. No, I think I actually said that wrong. Market structure shift, that's a higher time frame. Break of structure is a lower time frame where it looks like it's a market structure shift, but in the grand scheme of things, we're still in an uptrend. I had that backwards. That's my bad. But yeah, going back over here and going over fair value gaps. So what fair value gaps fundamentally are when first you have to understand liquidity. What is liquidity? Okay. In order to have a buyer, you have to have a seller. Okay. You have to have buy orders and you have to have sell orders. Now, when you have these impulsive moves, these impulsive candles that just move sternly in one direction, all right, that creates a market inefficiency and a market imbalance because you have a lot of buy orders, but you don't have a lot of sell orders. And the market has to correct that. So it essentially, these gaps function as a magnet almost for price to come back into before continuing in a trend. And you'll see that, right here. You'll see it right here. We scrape the top of it, we continue. All right. Same thing right here. Fair value gap. Is it wrong when I say that on lower time frames you have more market noise? No, exactly. You do. Think about the market like this. The wicks are all just noise. It's the bodies of the candles, the opening and closings, that tell the story, right? Because you look at this junk. You look at this junk over here, like all this stuff. It's just nonsense. But we look at a higher time frame, like maybe a 15. I don't even know where the fuck. Where the hell even was it? But you know what I mean. Like, oh, this is where it was. But all that junk are just wicks. They're just wicks. It's just noise. And you upscale to even a higher time frame, right? Oh my gosh, bro. Ain't no way. But at a higher time frame, look at that. Look at that. So, yeah, wicks are just noise. End of story. But fair value gaps, they happen on all time frames. Something to take note is price is fractal. So the things that you see on a lower time frame, you're also going to see on a higher time frame, and vice versa. You're going to see the same things on all time frames. So you're going to see fair value gaps everywhere. They're everywhere. So essentially, your lower time frame is just to see volatility more accurately, or am I looking in the wrong direction? Yes, lower time frame, that's for executionary. Those are executionary time frames for actually entering trades. The higher time frames are identifying bias and analyzing where price ultimately wants to go. And once you identify where price ultimately wants to go, that's where you break it down to the smaller time frames to actually find your entry. I'm confused on Chach and break of structure. Yeah, change of character. That change of character, you can also call it market structure shift. Those are interchangeable. Market structure shift, that is on a higher time frame, you're changing the trend. You're going from higher highs and higher lows to lower highs and lower lows, right? So you're just flipping from bullish to bearish. Now, and that looks like I said, that looks like this. Looks like this. So you have these higher highs, higher lows. These are wicks. But you have this candle right here that displaces through. And by displacement, I mean you have that impulsive move, just completely disrespecting that low. And we close through. We close below it, actually. And this is kind of what the Swift from bullish to bearish. Got bullish trend, higher highs. Yeah, exactly. So on a lower time frame, you see bearish market. On a higher time frame, it's bullish. Exactly. Yes, you have it. And once you have this displacement, also, this is what fits into silver bullet. This is what is important to understand. Is when you have that displacement, you also create that imbalance. So you also, that's why I say when you get the market structure shift, you want to see a fair value gap get created. This is what it looks like. This is exactly what it looks like. So you enter off this, fair value gap when it displaces, and you play on the continuation. It's basically the start of continuation of the trend. Break of structure is this is technically a break of structure right here. I'll put it right here. Break of structure. I'll put it in parentheses. It's basically a lower time frame market structure shift with no higher time frame market structure shift confirmation. So it just looks like a lower time frame market structure shift. But when you zoom out on it all, we're still in an uptrend. And to have a higher time frame market structure shift, you would have to break probably this low. Price would have to come down here. And that would be a higher time frame market structure shift. Exactly. It's not as complicated as people make it seem. But yeah, going back into fair value gaps. Like I said, does that make sense to you? How it kind of functions as a magnet for a price to come back and kind of correct itself almost? Yeah, there's a lot of really good videos explaining it and dumbing it down on YouTube. But yeah, my simple explanation for fair value gaps are they are a retracement tool for playing on continuation of a trend, right? So once you see, you know, prices go in a certain direction, you start to see, okay, these nice thick body candles in a certain direction, they're pushing and pushing, and it's a 3 candle pattern, right? So it's from the I'll do this 3 candle pattern. It is from the first wick, the top of the first wick in the sequence, to the bottom of the third one. And that is the gap that creates that imbalance that the market ultimately wants to correct before price continues expanding. And you'll see that. This is it's not hard when we have people like you that don't bullshit us. Tell me don't do. Yeah, exactly. Yeah. Listen, I've been there. I got plenty of experience doing this stuff. Um, I've been there. So I have a pretty good idea about it all. Oh my gosh. Why does price do this? But yeah. So this on a on a given time frame. We're on the 5 minute right now, so this is a 5 minute fair value gap. All right. Now you look for one of the next candles to wick into it. It doesn't have to be right away. Price might do some stuff, and then you want to see a quick in and a quick out. You just want to see a quick retracement into it and a strong reaction, and that signifies a retracement, so that price is correcting. I'm definitely staying with all you guys for the long run. Yeah, dude, I appreciate that. We just want to help you guys grow as traders. We want to build you guys into learning how to study for yourselves and being your own individual trader, so you don't have to rely on paid groups or signals from other people. And yeah, this guy seems legit. I appreciate that, man. But yeah, so it acts as a magnet. Price comes back into here. On a higher time frame, it's just a wick. On a lower time frame, it might be a full body candle that closes into it. Right. This isn't a good example, but this was our 5 minute fair value gap, and on the 1 minute, we come back in, we react off of it, we continue in price. Very beautiful stuff to use. Very useful information to know. And then price is fractal, so it plays on different time frames of liquidity, right? So we came back into this fair value gap, but really narrowing it down and breaking it down, we also have the same pattern creating another lower time frame efficiency on the 1 minute time frame, 1 minute fair value gap. So, and we wick into that. So price is very specific. Obviously, a higher time frame that gives you a more generalized version of where price is going to want to go. But that's why the lower time frame is very executionary, right? That gives you that optimal entry. Ultimately where price wants to go, but them lower time frames, they tell you the entry you want to take. So, Justin, does fair value gaps make sense? How it kind of acts like a magnet before price continues on a trend? And a lot of times you use fair value gaps as an entry, as you'll see in the silver bullet that we'll get to after I'm done. If this makes all sense to you, we can move on to that. Check gold. We have an entry. Am I correct? I'll check real quick, but it's not the priority right now. That looks disgusting. I don't even want to do analysis on that right now. All I know is I would not trade that. That's nasty. But other than gold, does the idea and concept of oh, right there, yeah, breaking it down, yeah, dude. So that's actually something called a BPR, which I will also get into. That is something called an inverse fair value gap. That overlaps with something called an inverse fair value gap. And I'll get in that concept here in a bit. But yeah. So that's what a fair value gap is. Exactly. Seems like you've grasped the basic concept of it. I'll break it down a little bit more as I get into what that you actually drew actually is. And I can see right off the bat there's actually multiple things. There's actually multiple reasons I can see that would be bearish. But going back into silver bullet, if the fair value gap and market structure shift, if that makes sense to you guys, I hope it does. So that is what we're looking for. We got a liquidity sweep, boom, check. We have a market structure shift that we are looking for that creates a fair value gap off that market structure shift. I mean, I could probably just market structure shift that creates a fair value gap. I'll just put that into one because that's pretty much one and the same. All right, so coming into here, what do we see? Like I said before, we have our higher time frame liquidity sweep. Okay, we're looking for bulls. Bullish is looking good, right? And I told you about our seek and destroy profile, right? So we have to be cautious of liquidity sweeps trying to psych us out and fake us out, okay? And that is what we are worried about over here. So you have to get, so you get both sides get swept. And that can happen. It doesn't just happen 2 times. It can happen multiple times. It can happen 3, 4 times. It's just that consolidation. And that's why I say do not take an entry outside of the zone, because that will happen before to accumulate those orders so that we have enough momentum for that move. So you have to be very cautious and very mindful. And that is why before we're even in this time zone for finding an entry on our silver bullet, we see, okay, we swept buy side or we swept sell side, but before we enter our time zone, we swept buy side now. So that tells me, okay, there's potential that the silver bullet could be playing off of this buy side of liquidity that we just swept for a bearish silver bullet, for a bearish move. Okay. Now this is higher time frame, so a lot more significance behind it, way more significance behind it, I would say. But given the nature, I don't know if you've pulled up the whatchamacallit. It might have gotten pushed up in chat, but I'll put the link here again. If you're following along on the chart, you'll look on the note that I put here. kind of breaks down the thought process on it. We just swept buy side liquidity before entering the silver bullet's time zone. Now, I say swept in quotes because it doesn't really pose a lot of significance on the grand scheme of things when you zoom out. You know, on the 1 minute, yeah, we have a high. Yeah, it's a high. 2 minute, okay, it's a high still. 3 minute, all right, it's a high. I get it. Now let's flip to the 5 minute. 5 minute, where's our high? We don't have any liquidity, any higher time frame liquidity that we swept. Okay? There's nothing there. Let's flip to the 15 minute. Oh, look. What is this that appeared? What is that? We have a fair value gap. Dash vertical lines. Is that? Yeah. So that's the time zone. I just put that, you know, just so you know, when price starts working through here, that's when we start looking for stuff. And I would say that it's very important, especially when you're starting out using silver bullet, that you mark those zones, because that keeps it in your head, keeps it in the front of your mind, right? Because a lot of the issue with some of this stuff is you forget, right? So you want to try as hard as you can to, you know, make sure you don't forget, and you have the info when you need it. So we don't have any higher time frame liquidity that we swept here, but moving to the higher time frame, we have a fair value gap that we actually tapped into. We actually tapped into it. So, and like I said before, covering the fair value gap, you know, concept, it works as a magnet, and if we respect it, then we consider it a price continuation. Now, we had a higher time frame market structure shift. So overall, if we respect it, you know, there's great potential that we can see downside. So we just have to be cautious, very cautious. Now, typically the bias of the silver bullet, it's determined by the most significant sweep. But obviously, don't just use the sweep. You want to use, you know, use higher time frame. Like I said before, start on the higher time frame, figure out, okay, I see where price wants to go. And then from there, that gives you a much better idea, a much safer idea. And that prevents you from kind of having your brain scrambled by this confusion of, you know, oh, it's doing this. Oh, but now it's doing this. And I don't know what to do. It just keeps telling me a different way it's going to go. And I don't know where it's going to go. So, but you just, that'll help you with that. But regardless, stay cautious. Just stay cautious, because there's never a guarantee in the market. Never a guarantee. There's never 100% possibility of something happening. Okay, so you got to tiptoe around it. Tiptoe around it. And given the nature of silver bullet, a lot of the time it is very reactive off of lower time frame liquidity. So, like I said, don't disregard the possibility of us seeing downside as we enter, you know, our time zone. And like I said, we rejected our 15-minute, 30-minute. So let's just proceed with caution. We'll just wait and see what price does. Okay, patience is key. So we enter our time zone. Let's see. What do we see? Higher time frame sell side sweep, significant for upside bias, and we have our lower time frame sweep from buy side. Less significant, but let's be cautious, because possibility. So at this point, what do we satisfy in the silver bullet model? A liquidity sweep. That's what we got. What are we looking for next? At this point, we want to see a strong reactionary shift or retracement in the market, or not retracement, just a shift in the market that tells us, okay, which we're inside this range right now. Where's price going to break out? Is it going to break to the upside or is it going to break to the downside? And that's essentially what we're looking for with a market structure shift, right? Is this one right? So that's a fair value gap. Is that a lower time frame fair value gap? Because that is not a, like I said, I'll put one. Let's see. Where's a quick one? I'll show you. Oh my gosh, why is this so gross? Lower time. Okay, so if you just took a picture on a higher time frame one, if it's like that 3 candle pattern, where it's these 3 candles right here, focusing on the little space between this wick and this wick, and that's your gap. That's your fair value gap, right between those. If that's how you drew it, then yes, that is your fair value gap on a lower time frame. Yeah, that's how you drew it. All right, beautiful, beautiful. It just didn't look like that because it looks like you're on a higher time frame. But awesome, great. So we're looking for a reactionary shift in market structure that creates a fair value gap or a BPR. What is a BPR? What is this? Fair value gap that overlaps an inverse fair value gap. There's a minor gap in 3 minute. This isn't right. So what time frame did you draw this on? Did you draw this fair value gap on? Can you go to the actual time frame? Yeah, no, you drew it correctly. Yeah, that is correct. Good, good. You're learning, fast learner. We love it. That's what we like to see. So now, once we're at this point, we know what we're looking for next. We know what we've already seen. So let's be patient. Let's let price, play out. Let's just see what happens. Okay, okay. So what are we seeing here? What are we seeing here? Well, we're seeing a bunch of disgusting consolidation. Absolutely putrid. Absolutely putrid. Do we see what we're looking for yet? Do we see a market structure shift or a break in either direction? Not really. No, we don't. On a lower time frame, yeah, we have a break of these higher highs, higher lows. But grand scheme of things, zooming out to the 5 minute, it's a mess. It's a mess. So, like I said, let's continue being patient and let's see what we're working with. Typically, I would consider we have to examine these ranges. This is the range that we are consolidating in. So, whichever way we break, whether it's to the upside or downside, that is where we need to start paying attention. And it's really we got to lock in. We got to lock in. So we got to wait. Let's wait. Let's see. Just play the patience game with this. Oh. Oh my gosh. What do we see? We're finally breaking out of these ranges. Finally. Okay, so that tells me, you know, we're looking for, not to give spoilers or anything, we might be looking for bearish, you know, at this specific candle. That's our thought, you know, because we have price displacing down on the 1 minute. On the 1 minute, we see that market structure shift. We see a fair value gap. Ultimately, I want to see, when you look for a fair value gap that gets created off of a market structure shift, you want to see a fair value gap get created through the low that it broke, that, you know, creates that market structure shift. That's where you want the fair value gap to typically be, because obviously you have this one, but when you have a fair value gap that gets created through this low, that has that displacement and disrespect through that low, that is a much stronger indication of, you know, it actually wants to go this direction. So let's see. Here I kind of put a note. If you look at the chart that I put in chat, here we close below our range on the 1 minute. You know, that indicates potential downside, but not so fast. We got to be patient. You know, let's move up to a higher time frame. See what we're working with. A lot of what you want to do is you want to wait for, you know, those higher time frame candle closures. You know, so time-based liquidity is very important. And what do I mean by time-based liquidity? You want to wait. I'm not talking about sweeping out highs and lows, but you want to wait for candle closures and candle openings, because the formation of candles, like I said, the opening and closing of candles, that tells you the story of the market. The wicks are just noise, right? So when you break it down and, you know, you move to the higher time frame to see, okay, what is a higher time frames, what does it actually tell me? Because the lower time frame, that's telling me something, but that's telling me one thing, but the other time frame might be telling us something different. Because at this given point in time, this is actually something I'm going to be low key. I might be writing an ebook. I might be. Shh, don't tell anybody. But one of the things I'll be explaining in it is the importance of these candle closures and something called half-life. A feature about candles is, in the first half of their lifespan, they will move one direction in order to create a wick of some sort, right? Like if you have say you have a candle, right? Ugly candle, but you have a top wick and you have a bottom wick. Even better, let's say it's let's make it a continuation candle. That'll probably make a lot more sense. We'll expand this down. That's disgusting. But we kind of have a candle like this. Say we have something like this. This is let's call it a 5-minute candle. This is a 5-minute candle. Okay. Now what do we see? Okay. We opened low. We created a low wick. We have a higher wick. And then we have our actual closing of the candle. We'll call it closed high. Now, at face value, just a plain old, 5-minute continuation candle. But I say you have to understand the behavior of how candles act. This is very just pure market structure experience derived. I haven't learned this stuff really from. I haven't learned this from anybody. This is from me just watching charts all day for 4 years straight. But it's something you come to notice is as a candle develops and as price develops, right? Say at the beginning of a 5-minute candle, you have a, this is where price opens, right? This is where price opens. We open, it might have a little wick or something. Nothing major. But it has a wick. And you'll see price, might continue down at first. Creating our, etc. Now you wouldn't disregard looking at this right now. Just focus on the lower time frame that I'm drawing right now. As price moves, right, price is going to start to reverse, and form these a continuation candle of some sort before ultimately I want to say let's do this. Move that up a bit, move that wick a bit, and then it might have a little indecision or something, a little bit of market indecision of some sort. Right, so this is a series of 1-minute candles, but it is directly correlated with how this 5-minute candle looks. So how this 1 minute looks is how this 5-minute looks. See these kind of that's not great. Consider this is a bearish. This is a bearish candle. Probably should have indicated that, but so you see this body inside. This is what the 1 minute, the collection of 5 1-minute candles look like. Now, when it comes to half-life, is about, notice how I drew it a pretty specific way, right? In the first 2 candles, it pushes one direction, and that creates that bottom wick. Now, because price ultimately wants to go another way, it's going to push and reverse into the other direction, over the course of the next, 2 candles, 3 candles, whatever. And that is why I say half-life, because about halfway through the candle's life, it'll start pushing the true direction that price ultimately wants to go, right? Like in here, even this, for example, a 1-minute candle, maybe the first 30 seconds of the candle, it opens up. So it just looks like this. There's no wick on it. It just looks like that. And then you'll start to see, it's pushing, and then it starts pushing the opposite direction. It closes right there. And then same thing with this next candle. It might do one of these, pushing up. This is like, imagine you're watching it live, but it pushes up right after it opens. Then after a little bit, it starts to break down. And that's why it does that, because on these 1 minute candles, after 30 seconds, it could happen before 30 seconds, but 30 seconds is like, that's like the safety net, I consider. That's like the last moment you want to look for, a candle to start reversing. So you'll see that, at this point in time, at these candles, we are 2 minutes in. We're 2 minutes in to 5 minute candle. Call life. We're 2 minutes into 5 minute candle life. At these two candles, just these ones. Now, this candle starts to develop. You start to see the same exact thing. It's bouncing. Looks like we might see some more downside. And then 30 seconds pass, because this is a 1 minute candle. We start to see the true direction it wants to push. Right? We close. This candle might do the same thing. But like I said, because for these two first candles right here, first two, we were 2 minutes in. Now, this wick right here, how long did that take to develop on this 1 minute candle? 30 seconds. Oh, isn't that interesting? What's 2 minutes plus 30 seconds? 2 minutes, 30 seconds. That's half the lifespan of a 5 minute candle. Right? Same thing. Same thing happens on all time frames, right? 5 minute, 1 minute candle to 3 minute candle, 1 minute candle to 2 minute candles, 5 minute candles to 15 minute candles. 15 minute candles have a half life too, and that's 7 minutes 30 seconds. Right? You might have a similar thing, except you could call this a 15 minute candle, and you could have a collection of 3 5 minute candles, or whatever you want to call it. It's going to have the same kind of behavior. So understanding that is essential when you're understanding price fractality. What I mean by price fractality is, like I said before, what you see on one time frame, you're going to see on all the other time frames. Right? You see on higher time frame, the patterns, how candles move. You see the same thing on lower time frames. Does that make sense to you guys? Do you have any questions about that? I don't see any questions, and it worries me. Yeah, I love that breakdown. Awesome, man. Awesome. And I feel like, yeah, exactly, dude. Like, I don't see like any of the videos that I've ever watched. I haven't watched a lot of videos. I'm a primarily self-taught. Just staring at charts all days and stuff. Obviously, I know like some ICT concepts. I've learned Silver Bullet, but primarily this sort of behavior. That's just from raw experience, and I don't see a lot of people putting an emphasis on it. And I think it's a big portion, of understanding the market. And the reason I explained all of that is because we come back to here and we're saying, okay, we have an indication of potential downside because this 1 minute is closing below this. But take note, at this point in time, it is 10:32. We are only 2 minutes in to a 5 minute set of candles. So we are only 2 minutes in out of the 5. And we want to see, a higher time frame, confirmation of some sort. So let's let a few more candles play out. Look at that. Look at that. So at this point in time, it is 10:34. Let's take a look at how our 5-minute candle looks. Look at that. That is a market indecision candle. Well, not market indecision. That is a hammer candle. Extreme hammer candle. Strong reaction. Very bullish. Hit in the fair value gap. Poof. Boom. Let's let this final 5-minute candle. Okay, so at this point in time, our 5-minute candle is now complete. This is why it is important to always analyze at critical time frames like 1 hour time frames. So like 10 o'clock, 9 o'clock, just hourly, like on the hour, analyze on 5-minute intervals, 10:35, 10:40, 10:45. Analyze 5-minute candles. Same thing with 15-minute candles. When it's 10:15, when it's 10:30, when it's 10:45, and when it's hourly candles too. You want to be analyzing all time frames. Same with 30 minutes. 10 o'clock, 10:30, 11 o'clock, 11:30, etc. So we go through 5-minute candle, looking good, looking very good. Okay, well this is, but we close the candle with this one right here. I'm gonna delete this stuff over here. One sec. And I know I'm throwing a lot of information at you guys, but do you guys want me to? I can post my recording for this, if you guys want. So if you guys ever want to go back and because I know I'm throwing a lot at you guys. Yeah. I'll upload it somewhere. I'll figure out something. I'll let you guys know. I'll notify everybody. But continuing on, let's keep going. Yes, please. Awesome. Okay. Continuing on. I haven't seen anybody notice yet. So let's which pair do you recommend do this strategy? Oh no, you can do this on Forex pairs. You can do it on UJ, EU. Let me see if gold does it. I think gold does it, but I don't know. Gold is a lot more iffy price action. Well, I don't trade Forex, so I don't trade pairs, but I use it on the NASDAQ, S&P 500. I trade oil. It works across the futures markets and in the Forex markets. So you don't have to worry about specific pairs. No, I don't only use this strategy, but it's a very critical strategy to have in the back of your head, even if you're not using it mainly. It's very critical to know, because when price respects these things, that gives you a lot better confirmation of the bias. So even you're not using it in your main strategy, you might enter a lot earlier than someone will. You might have a lot better optimal strategy. But mid trade, as price develops, things change, and using this as confirmation confirms your bias and allows you to be a lot more comfortable. And that's why I say always learn new strategies, because overlapping strategies and models with each other, that gives you further confirmation for market direction, and it allows you to be a lot more comfortable to trust your system and have that and mitigate that emotionality that comes with trading in the market. Trust in your system is everything. So the more confluences you add, the more models that you can overlap with each other to, find yourself some A+ setups. That gives you a much more analytical mindset, and that brings you so much closer to being a profitable trader. So, like I said, I haven't seen anybody notice. So remember, going through our confluences, what confluences we have? Liquidity sweep, we check that off. Market structure shift, that creates a fair value gap. Okay, on the 1 minute, we kind of got that, not really. 5 minute kind of disregards it. However, let's look at our 15 minute. So 15 minute, we tap into here. Now, what is our entry? What's our entry look like for silver bullet? Our entry is the top or EQ of a fair value gap. Huh. Well, okay. Well, we just tapped into a fair value gap. We're respecting a fair value gap. That's interesting. But remember how I said your confluences can appear before this time zone happens, but you only take your entry in this time zone. And I say that because we go back and we see we had our market structure shift back here. We already had our confluences. We've checked off the boxes. And our checklist is now complete. Would you be setting a buy limit, or would you wait to see it turn around? See, I mean, that depends on how you trade. Me, because you can never be sure, so the market shift have to get momentum, create for value gap to trade from. Yeah. That's what I mean by displacement. Displacement is that momentum through those, previous highs or lows that creates that, that push in a direction, that creates that gap or imbalance on a higher time frame. We'll be setting a buy limit. So me personally, I would in fact set a buy limit at the top of this fair value gap to trade from. Now, the thing, setting a stop. I'll get into this in a second. But yes, you do. That is your entry you want to take for silver bullet. Is you want to take the top of whatever fair value gap that is created, because we had a market structure shift. Now, we didn't have a market structure shift on the 15 minute, but that's okay. That's okay, because on the 5 minute, very nice, very strong. We like it. But I did not enter when I was looking at this live. I was not comfortable putting an entry there, solely because, like I said, you got to wait for the 5 minute candle to close out, and I was too unsure at this point in time at 10:32, like how I said with this 1 minute, because we closed before, but you have to be patient. You have to see how the higher time frame candle behaves and closes out. So yes, you enter off the higher time frame fair value gap. Now at the time, I realized it 2 minutes right before this 5 minute candle actually closed out. I was like, oh shit, we actually had this market structure shift before. And even me, I get confused. I miss it sometimes, and that's okay. But that's why you gain experience, and as you gain experience, you always have these things in the back of your mind. You're always on the lookout. So yes, you would enter off the top of fair value gap. Did I? No, I did not. Now in regards to, let's look at our 15 minute, or not 15 minute, but our 5 minute. So our 5 minute, very strong reaction off this 15-minute fair value gap into the 5 minute close. This indicates significant potential upside bias. Wait a minute, I already said this, but we already got a liquidity sweep. What did price just do? We tapped into a higher time frame fair value gap. Where did the fair value gap originate from? It originated from our market structure shift that created the fair value gap. So we have now satisfied the entire silver bullet checklist. We got a liquidity sweep, market structure shift, fair value gap. And these are all in the direction of our bias, which is we're looking for bulls. So this is our entry. This is our entry. I shouldn't say this is our entry, because this was I did this after the 5 minute candle closed, and you'll see. So let's flip back to the 1 minute. So what are we seeing on the 1 minute? Okay, on the 1 minute. So this is where remember how I said back here. What are we looking for? What are we looking for? Looking for a strong reactionary shift in market structure, creating a fair value gap or a BPR. I feel like I worded that wrong. No, I worded that right, because it is a reactionary shift. But we reacted strongly off of this 15-minute candle, but a fair value gap or a BPR. Now there is a fair value gap that we did create, but on a lower time frame, I'm looking for something that's a little more solidified, with our bias, and that is what a BPR is. A BPR is a inverse fair value gap. Oops, this inverse fair value gap that is overlaid over a regular fair value gap. Now, what is an inverse fair value gap? So you see with candles, right? That you have. Let me find a solid example. It would be way more beneficial to actually show you guys. Oh, is this one? Is this one? Alright, I'll just draw it out. But this is a BPR. So we have in this BPR, I'll do this. This is our BPR. Now we have two things. Here, when we take a look back in price. Let's go back. We look back here. Remember, we had a bearish fair value gap. Bearish fair value gap. Okay? Now, we look for typically in a fair value gap, we look for, rejection, for continuation. However, in situations where price just, price don't give a fuck, all right? And it just closes right through, completely disrespects it, doesn't give a fuck about it, does not give a fuck about it. That does not invalidate the BPR, or not BPR. That does not invalidate this fair value gap. What it actually does is it now flips it into a bullish fair value gap. But because it was once a bearish fair value gap, everybody we call it an inverse fair value gap. And what an inverse fair value gap is it is used as, there's still that price imbalance that's there because we displaced hard in one direction and price didn't correct itself. It didn't necessarily correct itself. Instead, it completely displaced in the opposite direction. So now we have a double imbalance. A double imbalance in both directions. On the sell side, we were missing buy orders. On the buy side, we were missing sell orders. So what now the inverse acts as is a bullish sentiment for continuation. So we have that inverse now. Does that make sense? Do inverse fair value gaps make sense? All right, sweet. All right, so we have that inverse. But now, when we displace through this, we now also have just a normal bullish fair value gap. A normal bullish fair value gap. Very good. Now see, these overlap. And when you have these situations where these two things overlap, that shows that you have that double imbalance, and that's essentially what a BPR is a double imbalance. So we have that. What am I calling? That is where price lines up on both sides. So the one fair value gap doesn't get respected, but the move that doesn't respect. Yes, exactly. And that's what you look for when you look for a reaction off of a fair value gap like this 15-minute, or just a reaction in price overall. If you have like an order block or something, or breaker block, these reactions they're so good. They're so good. And you'll see even also how it kind of relates to, man, dude, there's so many relationships and connections that you can make in the market, but you can see how it also kind of relates to a head and shoulders pattern, inverse head and shoulders pattern. Ain't that shit mind blowing? So like I know like market patterns, yeah, they can be bullshit when used the wrong way. But like using them in confluence with these things, stop playing. So we ultimately look for an entry. We're looking for an entry off of here. Now these can be dangerous on a lower time frame because price isn't always, if the reaction is strong enough, and it is pushing for a higher time frame move, it may not retrace all the way back in. Yes, that is a desired entry zone. Usually I don't enter right off the top of it. As soon as I see that it's created, I'm entering, because there's never a guarantee on a lower time frame, especially the 1 minute, that we are going to for sure tap back into that. And especially because we're playing off of, remember how I said earlier that the typical nature of the silver bullet is, being reactive off of lower time frame liquidity. However, the things that we're looking at, we had a 5-minute market structure shift, and we're reacting off of 15-minute fair value gap. So I recognize that as us, we're reacting off of higher time frame liquidity, right? So, and because of that, at this point in time, 10:35. Let's see how what does our 15-minute look like at this point? Oh, well, that doesn't really tell you much, but it would look like at that point where that BPR is created, it would have, it looks like a pancake. It would have a hammer candle look to it, right? And that was only, I want to say, that was 5 minutes in to this 15-minute candle closure, right? And remember what I taught you guys about the half-life of candles, how it pushes in the first half of a candle's lifespan to create like a bottom wick, or move in the direction where ultimately it's not going to push to create the wick of the opposing direction where it's going to move. So we're nearing the half-life of this 15-minute candle. So we're going to start looking, as we get closer to it, we look more and more for us to see the candle actually push up, in the direction we want to see it go, right? So guard to that. So right here, at this point in time, right here, this is our half-life. This is where, at the least, or this is the last place that we would wait to see price actually start pushing in the direction we want, which is the upside. So, and there's no guarantee that in 2 candles, we're going to tap back into this BPR. So you'll see, I'll put this back. You'll see that. So are the 2 spots. So those are 2 spots you entered. Yes. So after that closed bearish candle, some bulls has been created. Entered. Yeah. As soon as I see this BPR get created, and that's created after this 3rd candle, this black one, is created. As soon as I see that gap, like I'm in. Yes, exactly. And I actually marked this wrong, but I actually entered when I saw this candle push down. Where do you put your stop? Let me get to that. I'll get to that. Don't trust. Don't worry. So I saw this candle push down, right away after it opened. So I entered. We pushed up. Now, Marcel, the thing about me and how I trade is I do not have a stop when I enter the trade. I wait to see how price reacts after I've entered before I place my stop. I know it sounds risky, but when you have stacked confluences like this and you have actual like A+ setups, it's a lot less of an issue. Obviously, I have like a mental one, but you don't want to go too far down because according to the rules and the guidelines of the silver bullet model, your stop should be below the most recent swing low or above the swing high. If I put the stop below the swing high, I'm not going to put it right under here where we just reacted off of, because as of right now that's a lower time frame swing, so it's a lot more risky. And a higher time frame swing, that's way out here. Come on, man. But I would put it below this 15-minute fair value gap. That's where I personally would be comfortable. But sticking to the rules of the stop, you're supposed to put it under the swing low or swing high. But like I say, you start trailing as needed. And this creating this BPR, like it did, that tells me that because we have that such significance, so you're looking live how it's reacting, may it break through the fair value gap and you close manually. Well, when I say I don't have a stop, like I do have a stop, like, but like it's more of like a mental stop of like I doubt price would go, would push down this low, and given how price has developed over, X amount of time and how it's looking, and the features that I see, like if it pushes under, this spot, then there's no way that we're gonna, just reviewing how it's reacting before I have a firm, this is where I'm gonna set my stop for sure. Nothing concrete. Obviously, this is where my stop would be around, in the back of my head, in case price decided for whatever reason, maybe we go to World War III, Korea hits us with fucking nukes and price tanks. I'm out. Because you never know, something might happen unexpected. You never know. I'm not a fundamental trader, but like I say, there's always a possibility. There's never a 100% guarantee of anything. So it's better to be safe than sorry. And the whole thing about trading is risk management. So I don't trust myself to enter without a stop. Not yet, at least. No, I mean, like I said, I'm not entering without a stop. I definitely have like a mental stop in the back of my head. I have a limit order I usually set, but like it's definitely out there. But this placing it way down here, that's way too far. Because given how price has been, and we're looking for bulls, if price were to come down to this point, that means that we're stupid and we didn't realize that we had a bullish or a bearish silver bullet. Because if we had a bearish silver bullet, this low, the swing low, is where we would be targeting for a price to hit. So there's no reason to put our stop there. It's an asinine. It's asinine. Because like you're essentially admitting to yourself that you might be wrong. Ego. No, I'm just playing. But yeah, so we look at here. So we now have our entry. We created a lower time frame BPR off of the reaction, tapping into the silver bullet. 15-minute fair value gap. Where do we place our stop? Typically you're going to place it, like I said, under swing low. It's a long ways away. We don't want to accidentally set it too tight. Like I said, setting it under here, very, very risky. Because even though we had this reaction and we closed the 5-minute candle out like this, yeah, it's a hammer candle and it's bullish. However, in the development of the next 5-minute candle, there's always a chance that price, when it opens in the first half of its lifespan, it can come down to create a pair of wicks and immediately react the same way off of it, to continue higher. There's always a chance it could create a weird set of wicks. Yes, but in this case, you got the BPR. You can still tap further into the 5-minute fair value gap. Right? Yes, exactly. You're on the money. You're on the money, my friend. And I say this also because, like I said, in the first half-life of this next 5-minute candle, we risk creating, a pair of wicks, And then if we have our stop right below this, we get wicked out. We get used as liquidity, and the market makes us look like a bitch. And I say that in the first half-life of this 5-minute candle because remember the 15-minute candle. The first half-life of this next 5-minute candle, that will have been 7 minutes and 30 seconds into the 15-minute candle. And narrative ain't no bitch, exactly. And narratively wise, it's a very possible thing for, because we showed a little rejection here. Yeah, we have BPR, but BPR, that's not always, you're not always going to respect it. It's not a 100. Like I said, nothing's 100% the case. There's plenty of times in the market where BPRs are disrespected, especially given on a lower time frame. It's possible. So price could quickly shoot down again, create that wick in the first 2 minutes, and then immediately continue fast. But let's let price play out a little bit more. Okay. So this is good. This is nice. So we have now at this point created our next 5-minute candle. Full body candle. Very, very bullish. At this point in time, I have that confirmation. Remember how I was saying, kind of have that inverse head and shoulders look, pretty bullish. And all signs that we're looking at right now, everything's pointing to bullish. Everything. So at this point in time, safe to say, I'm confident we can place our stop under here, or like what I did was I placed my stop slightly under this BPR. Because the reaction is just so strong since we're playing off of higher time frame liquidity. The expansion is going to be a lot faster. There's going to be less retracement. So we're a lot less likely to come back down that far. So, and let's continue back into it. So we see where to place our stop. Now, where are price targets going to be? So remember, we look back in our silver bullet guide. Our price targets, typically, I don't know why I didn't put this, but price targets, guaranteed minimum, futures only, but you're going to be looking for opposing liquidity. So you're going to be looking for previous swing highs, or higher time frame PD arrays. And what are PD arrays? PD arrays are fair value gaps, order blocks, inverse fair value gaps. It's just those things that appear on the higher time. Just one question: is it wise to monitor this on just one of two pairs? I think I'm going to check this next week on SP 500 and NASDAQ, because if I do more pairs, it will be noisy. Typically, I have extreme favoritism towards studying silver bullet on NQ, just because in regard to Forex, I really just don't like Forex price action. My whole market experience is based on U.S. domestic markets, stock market, SP 500, NASDAQ, all of those stuff. And, Forex moves a little bit differently. And it's a lot smoother on the NASDAQ, so I consider it a lot better in regard to studying at the least. Because it's just a lot smoother. With Forex, I feel it's more noisy, but Then again, I don't have as much experience with Forex. Yeah, NASDAQ, SP 500. Maybe the best if you're normally trading Forex. Well, I mean, if you're normally trading Forex, yeah, if you're normally using Forex, you know, yeah, like start out, on the Nasdaq, get a little bit of experience, a little bit of sense of, what the setup is about. You have to have a lot of situational awareness, because there's so many different situations that form in Silver Bullet. How many trades do you usually take on average per trading sesh? One trade. One trade. You look for my man. Yeah, exactly. See, the thing is though, with me, I don't trade. I actually don't trade these sessions, these time zones. I don't trade the New York session. I don't trade. Um, People hate me for saying this, but I trade the night sessions. I trade Asia. Asia is extremely underrated, solely because of the confluences and the setups and the way that I trade. It's extremely algorithmically based, and because you have that lack of volatility in those hours, price is it's a lot more algorithmically based rather than um, you know orders, and people actually buying things. Obviously, people still buy stuff at night, but back testing, it's just a lot more algorithmically for me. So I'm usually trading at night, but don't let that stray away from you from how great these silver bullet time zones are. This the 10 a.m. to 11 a.m. this morning session, silver bullet happens nearly every day, nearly every day. And I say nearly because it could happen for weeks at a time, and there could just be like one day in like a month where it doesn't happen, and so what? Who cares? But it's very very good. And you don't have to worry about that. Okay, bro. I'm gonna check this. I've got to go for now. Of course, of course. Thanks for popping in. Hope to see you guys. I'll be doing calls next week, so be sure to pop in. We'll do some more silver bullet stuff, and I'll upload this recording and stuff somewhere. All right, see you. All right, yeah, diving back in. Yeah, you don't have to worry about if silver bullet doesn't happen. What if it doesn't happen? Well, then you don't fucking enter. Because if it doesn't happen, that means these things don't happen. These confluences don't happen. If these confluences don't happen, then you don't enter. It's just as simple as that. So you don't got to stress about it. It's a great setup. So, like I said, with our stop, we're going to be, or not stop, but price targets, we're going to be targeting, previous swing highs. Since we're bullish, we're targeting previous highs. If we were bearish, we would be targeting previous lows. You know the deal. You know the deal. But you can also target previous higher time frame PD rays. And I mean PD rays, like, we can disregard this. I don't know. But this will be our first stop. TP1. This is our most recent swing high that we made right before we were entering inside of the silver bullet time zone. So that's going to be our first TP. Given the nature of this silver bullet, all right, bro, see you, man. Given the nature of this silver bullet and how it's such a higher time frame, all these reactions are higher time frame. You can look for higher time frame swings to target, higher time frame points of liquidity to target. So not only do we have this TP1, but we can go back and we can say, okay, where else is orders? Where else are orders sitting? We could say, we could go as far to say we can make this a TP. I'm sure a lot of orders are sitting up here. Me personally, ultimately, for anyone to trade silver bullet, this is say I created Liquidity frame and entry time frame is easy to edit. Questions? Oh man. Oh man. Damn. Have you always had this in your back pocket or what? It's kind of goated. I've always wanted to have like a thinkorswim kind of indicators. Not indicators, but like, you know what I mean. But obviously, TradingView uses Pine script. Oh, yeah. For TP1, I'm targeting this overall like mega high time frame liquidity. That's going to be TP1, or not TP1, TP2. Or wait, am I tripping? I think I might be tripping. Yeah, I'm tripping. I don't know why I put this here. Was that there before? Nah. But yeah, you could use that high. Use this high. I use this mega time frame liquidity just based on the higher time frame behavior that it's showing. I went back in price. You know, what else are we working with? What else do we have over here? So we have big swings that we've been working with. We can see on a higher time frame, big dip down. You know, you think about it. Same thing here. It's kind of like a messy BPR, kind of nasty, disgusting. And we tapped into that. You know, I don't know the exact, how it's drawn, but we tapped into that. So now on a higher time frame, we have that same look. God damn, we have that same look. It's crazy. Inverse head and shoulders. So many connections, my brothers. So many connections. So many things. So many ways of looking at the market. And we're showing the reaction. We're respecting that inverse head and shoulders model that beginner traders might try and use and get screwed. Cup and handle, yeah, that too. A lot of times you can also visualize cup and handle as a a sharp displacement in market structure, creating a fair value gap, and then you have a correction to that imbalance. Because ultimately, this right here, that's a fair value gap. So it's the same thing. It's like all of these things are, it's the same stuff, just different ways of saying it and displaying it and recognizing it. Cup and handle. It's just accumulation as price starts to reject and or reject or react off of a imbalance for continuation. It's all the same stuff. Really. It's really fascinating. The market's like a big puzzle, and you just got to fit all the pieces together. A lot of the pieces are the same. They look the exact same. Sure, there's all the pieces have a little bit difference to them, but it all fits together so beautifully. So, yeah, this is our TP. We go back. We're looking for that head and shoulders kind of formation, so we're expecting like a big push. So we're going to target, this area of liquidity, this little high right here, because you never know if we have it could react off a trend line for all we know, or something like that. So you don't know if it's going to go all the way up here, but that's why I left that as a runner. So that's like a secure TP2 that you can place. I did this. I actually placed this later on, after price was developing a lot more and after the time zone. I'll get into that though. Dude, there's more to this. There's something called an evolving silver bullet. And that is what this is, and I will get into it. Because there's just your standard setup, and then you have the evolved setup. which is the overall aspect. That is the setup, and those are the days that you want to catch, because those are the trending days. And your overall goal as a trader is to catch those trending days. You know, traders, you're supposed to ride the trend. That's the whole point. You trade with the trend. You don't fight the trend. So we catch this trend early on with this silver bullet. And the evolving silver bullet, it's absolutely gorgeous, absolutely beautiful. So we have our trade down here. We enter. We're looking at a. Let's see. Let me lower this because this is more realistic as to where. But even with that, those are our targets that we're targeting. We're looking at a 10.55 risk to reward ratio. A 10.55 RR. That is absolutely insane. I mean, and you can only imagine if, what if you entered down here? What if you recognized that this was a silver bullet, before, and you entered off the top of where you should have actually, realistically based on the model, where you should have reacted off? That would be, you did the same thing. You place your stop under this wick, you're looking at a 13 RR, or even a 14 RR. Very high confluence, very high probability, very high risk to reward ratio for evolving silver bullet. Typical silver bullet setups, you're going to get, I say 2 to 3 RR, but when you're really playing your cards right, it's 3 to 5 RR. It's very nice. So yeah, we're looking at 10.5 RR right here. So let's keep letting it play out. All right. Boom. TP1 hit, flying colors. We move our stop to break. Even you could even put it a little bit before. Or not. Yeah, you can put it above your break even. Push that we've had. It's just price is a lot more likely to continue than to come back down that far. So that's why I say, trail your stop. On trending days, you want to trail your stop, because when you have those trending days, it's a steady trend and it just keeps inching. But ultimately, at some point, there's going to be a big retracement, and you don't want to get caught on that big retracement. So you want to be trailing your stop on those trends, on those real trends, on these trending days. So we're pushing up. We're risk-free. Things are looking great. And we're just going to be patient. We're going to see what price is doing. Okay. All right. Well, so here's the thing. This time zone is extremely critical. Extremely critical. And this is an expansionary move in the fact that, remember what I said. Let's see, where is it? 2 minute? Yeah. All right. I hid this stuff from you guys to surprise you. Everybody else didn't see it. But that's okay. Because it all connects. It all connects. So I'm going to put this on the 1 minute. All right, let's flip to the 1 minute. All right. What is it that we are seeing? What is it that we are seeing? Accumulation, manipulation, distribution. What is that? What? Well, remember what we went over earlier? Whole thing about the silver bullet is an expansionary move. You are playing on the distribution. Disgusting arrow. But you're playing on the distribution stage. Remember, we have 3 stages in this. Accumulation, in the form of collecting orders, maybe in a search and destroy, consolidating in some crappy range. And then you have some form of manipulation in the form, retracement of some sort, a higher time frame. Comes back up. Then, what do we have? We have distribution. Distribution, baby. Fuck yeah. So, the power of 3, which is what this is also called. 3 stages. Boom, bam, pop. Typically what it looks like, obviously you can flip the direction however you want to. It happens in different ways, but accumulation, manipulation, distribution. 1, 2, 3. What do we see here? 1, accumulation, collecting orders. Manipulation, we had her push to our downside. The manipulation making us think that on a lower time frame, this was our silver bullet to the downside, and that we should enter bearish. This is our manipulation. And then we have our distribution. This is our distributionary move, our expansionary move. And it's kind of coming to an end at the end of the time, end of our time zone. And that tends to happen. Usually you want to be out of a silver bullet trade at the end, by the end of this time zone. However, a lot of times it does extend out to like 11:30. Some moves, because then lunch hour starts to hit, and we all know lunch hour is just a hot fucking mess of a heaping pile of shit. But now at this point, we've reached the end of the silver bullet time zone. Okay. Now that's interesting. I saw something before that I didn't see. I don't see this time. What the fuck? There was a gap where this candle opened a lot lower. But I guess it's not there. But it appears like it might be coming to an end, right? You'd think. Not so fast. Not so fast. Because at this point in time, remember, what is it that we have to do? Look at the time. Somebody tell me, answer. What is it that we do? What are we doing? What do we need to do at this point? Remember how I was saying time-based liquidity, you have to, when those intervals hit, 5 o'clock, 10 o'clock, or not 5 o'clock, but 5 minutes, 10 minutes, 30 minutes, 15 minutes. At this point, what do we need to do? Somebody tell me. I know y'all know. Or if you don't know, just say, I don't know. Just please, a response. Somebody. All right. We go to the hourly time frame. Hourly time frame. Because our hourly candle has just closed out. And that is critical. Very critical. And we look here and we see, okay. It's looking like it's looking bullish, is it not? It's looking very bullish. I'm really curious. What were you gonna say, Queso? I was typing. I should host live trades. Yeah, I know. I'm very passionate about like the educational side of it all. Um, Xander's the face of the server right now, so like I'm mainly letting him, you know, he's doing the live trading and stuff. Um, pre-record them and guide with commentary. I know, I should, and I will. I definitely will eventually. Um, you know, but like I said, I'm passionate about the educational side of this. And like, yeah, this server is like meant to, you guys can live trade with, Xander, and you can get signals. But we also started this with the goal of, we really want to educate people, the right way on how to actually not just teaching these setups, but teaching people the thought process that they need to have when they're trading, so that they actually know how to um, study on their own. Yeah, metacognition, understanding your own thought process, your own triggers, to your emotions, why you think the way you do, um, and truly analyzing your losses, um, to like really understand your pitfalls. Yeah, emotions, exactly. Understanding your thought process, that's the most critical thing, because once you understand your thought process, then you can start to, like I say, you identify those triggers for your emotions. Why am I thinking the way that I do? Once you identify why you think the way that you do, what triggers it, you can then figure out how to fix it. Once you fix it, you gain a lot more trust in yourself, so you're more confident entering trades. You can trust your system a lot better. If you understand the plan, you trade like a bot. Exactly. You become analytical. You have to be analytical within yourself. Within yourself. Yes, the markets, but within yourself. Because if you can't control your emotions, then risk management means nothing. And then these setups mean nothing. Because yeah, you can have good trades, but in the situations where price, where you place your stop, where in the trading plan it tells you to place your stop. If you don't place it there, um, you lose a lot, because the stop is there for a reason, right? Because analytically, statistically, we say in the trading plan to place the stop there because statistically, when price hits that point after this setup occurs, price is most likely to dump, or go the opposing direction. So, and people don't realize that, because when you don't have that risk management, that self control, that discipline, that management to do that, you fuck yourself over. So, but we look bullish on the 1 hour time frame. So, dang it, spoilers, bro, spoilers. We look bullish. Okay, excuse me. Pause. Rewind. We're looking bullish. Okay. So, even though we're near the end of, this time zone, um, you know, it's okay. That's okay. I think we could let this, we can let it run, considering how we analyze the higher time frame, and came to the consensus that we're expecting a large higher time frame push, an expansionary move based on the inverse head and shoulders, this rejection off on this a rebalance, or inefficiency in the market, um, and how everything's setting up and reacting off higher time frame confluences rather than the standard lower time frame, as I was saying. um, the potential is there, and if the potential's there, what's the harm? Especially if we're risk free. So we do just that, and we let it ride. And it's looking. You look at it at this point, and you might say, "Oh boy, this ain't looking too hot." But remember, let's see, where's it at? Where's it at? Where's it at? Get to the point. Get to the point. Bro, it's so perfect. It's so perfect. It's so perfect. It's not even funny. It's so perfect. It's not even funny, dude. The candle half-life. You remember things I taught you. Moves in one direction halfway through. Then the second half, it actually pushes the way it wants to go. The first half of this hourly candle, it was pretty much bearish. It was bearish at first. Yeah, it kept pushing up. But overall, it's staying, in this zone. But as we approach the 30-minute mark, or the half-life of the hourly candle, we start to see that it's pushing in the direction that it actually wants to go. Isn't that crazy? Isn't that crazy? So once you see this, once I see this break of this previous high and this timing, like I said, time-based liquidity, this timing of the movement in the hourly candle, that tells me, okay, we're going to push up hard. So yeah, we have these two price targets, but now I'm looking at this swing high all the way up here. But obviously that will be a runner. You want to scale out of your position. That's a part of risk management too. Scaling out, very important. But it's less important when you continuously get confirmation after confirmation of price following your trading plan and doing what you want it to do. Then you can sit back, you can be relaxed, and you can be a lot more confident of it reaching this high. Need to learn to scale out. Yeah. It's scaling out is I would say that's more advanced. Definitely, it's a more advanced skill to develop, because, like I said, you have to come to know price and come to like I said, come to know price and see as it's developing in your trade, that it's confirming and confirming and confirming what you want it to do. And, gaining those skills to recognize, those confirmations, that will assist you in, being able to scale out of your trades and trail your stop properly when you can realize those critical points. So back to here, we got our 3 profit targets. We got through 1, we're risk-free. We're approaching number 2. It's safe to say we can place our stop under this low very confidently. Move stop under swing. Actually, I'll put this right here. We'll say trail stop. Under new swing. When broken. So we're chilling. Things are looking good. We let price do its thing. Let's let this 1 hour candle play out. We'll let it play out. Okay, boom. Profit target 2 hit. And price is it's still forcing itself up. This in no way, I'm not even gonna lie to you. This does not look normal. That does not look like normal price action. But well, I mean, it's normal price action, but it doesn't usually happen this much. Yeah, all algo. It's that algo. So once you're at TP2, race stop to our next low, etc. But let's just keep letting price play out. How close are we to? So we're almost at a 12 o'clock mark. We're almost at lunch hour. Okay, we're starting to reject. It's making me a little worried. Okay. Lunch hour hit. We're starting to get volume. We are starting to get volume. Let me do this. So you can see on the 1 hour. The 1 hour, we pushed up pretty good. We pushed up pretty good. We didn't finish this full body, but we still have a continuation pattern. So in this next candle, we can expect, I'd expect at the least a pair of wicks of some sort to form. If we're to see any downside at all, I want to see a pair of wicks. So I'd like to see, in my head and in my thoughts and in my trading plan, I want to see us push up, in the first 15 minutes of this next hourly candle. That's what I'm thinking. And hopefully, just hopefully, we can knock out that TP3. But, it's never a guarantee. So we'll see what price does. As you already saw, 12 o'clock hits, we get a little impulsive move. It's trying to reject a little bit, but we haven't broke to the downside yet. We're still consolidating in this range. We're in here. We tried pushing down. But she ultimately just did not want to see any upside. or any downside. I'm curious. Where's it at now? Oh my gosh. Okay, so great spot for an exit, for sure. Great spot. But yeah, that's the what are you confused on? Is this live? No, no, this was bar replay. So you can go through and you can block yourself from seeing future price, so you're not looking at things retrospectively, you know, because a lot of people, they look at price and they're like, oh, I would have done this, I would have done that, etc. Um, but I did make most of these notes live. I was in class trading this um, during it all, so a lot of these notes were live. Yeah, we're live. Okay, I was gonna say it. Mark it down at the close. Confuse me. Yeah, 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 yeah. No, that's just bar replay. It's such a great back testing tool. If you don't have it, I highly suggest you utilize it. Very good tool.